From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Thursday the 19th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel over in New York. Welcome, everybody, to Bloomberg Markets. Alix, I got in this morning. The Asian equity session really didn't look that clever. Commodities getting smoked. Europe then kicks off in pretty similar fashion. Again, a similar narrative. You add in the luxury stocks. I'm looking at my Bloomberg screen right now. Wall Street, not so much.
Yes, it's amazing. So it's really slamming the brakes on the global equity rally, yet the potential to buy the dip in U.S. equities is quite still there. I mean, the S&P is now down only 0.1%. We were down 4 times that earlier in the futures trading session. Obviously, you have energies and the cyclicals getting hit hard yet again. You can see that with Brent off by over 2%, but all the commodities really getting smoked. The big mover, I think, and the big catalyst for this is the dollar. So the dollar index at its highest level in 9 months, up 0.3%, and that's wreaking some havoc here across the equity market, very much so in the commodity market, which explains why European equities are getting hit so hard, because they have so much exposure to metal and mining. If it was a real safe haven flood, though, a real bid there, I would expect yields to be down even more in the U.S. And you're seeing very modest buying coming in. I really do have to wonder, we're almost now at flat for the S&P, and as we go through this session here, we're going to see that buy the dip reversal.
Yep, we've seen it time and time and time again. What is also interesting is that gold is not moving that much and volume is not picking up that much here in Europe. It is the middle of August. We're a bit above the kind of the 100-day average, but nevertheless, it doesn't feel like that huge cathartic moment maybe that we've been anticipating in stocks. Nevertheless, if you aggregate it all together, global stocks are down. We are seeing that dollar rally, as Alix points out. What's driving this? I think you've got the Fed in this. You've got the growth narrative around Delta in this. You've got what is happening in China in the mix as well. That's certainly hitting the CAC here on with luxury stocks. Let's dig a little deeper. Bloomberg Markets reporter Abigail Doolittle is going to do just that.
Well, Guy, quickly moving markets here. And to Alix's point, it does seem to be a buy the dip moment, because earlier we were looking at the worst 3 days for the S&P 500 in a month, for the Nasdaq 100 since early May. And right now we have the S&P 500 trying to flip higher. Now, a big story yesterday was the VIX at 23, telling you that fear was back in the markets. The VIX is now lower. It is at a 21, so it's not complacent being above 20. But nonetheless, this is a little bit of a reversal. And it's certainly a reversal from that weakness that both of you were outlining in Europe, with the stock 600 now off its lows. At the lows, as you know, down more than 2%. At that point, the worst day of the year. With the Asian session, that was really starting the weakness. That Hang Seng down 2.1%. A lot of that on the commodity sell-off that I know Mike McGlone will be detailing. But something else I want to point out is the reason that we know that this is such a risk-off tone, even though it seems that yesterday some of it was set off by the idea that the Fed might taper this year. Even with that possibility, you have bond yields in. Over the last 5 days, you have the 10-year yield right now in about 11 basis points, speaking to the fact that investors are uncertain. They are seeking safety, Alix, even with the S&P 500 now trying to be just about flat on the day.
Yeah. I'm still skeptical as to how much safety we're actually seeking here, and so what's moving the dollar. It felt like it was already kind of making a move here before the Fed minutes from yesterday. Bloomberg's Abigail Doolittle, thank you very much. But that stronger dollar definitely having repercussions all over the place. You can make the argument that U.S. exports then are going to become more expensive abroad. Input costs potentially are going to rise if you're exposed to that dollar. You're also going to have the repercussions for commodities as well, much lower. You also can make the argument that, well, maybe that's not so bad. China in particular, Guy, has also been trying to lower those commodity prices. So let's get a little deeper into that. We have Chinese steel producers not working as hard. You got iron ore getting crushed, copper getting creamed, oil getting hurt. Mike McGlone, commodity strategist for Bloomberg Intelligence, joins us now with more. Hey, Mike.
Hello, Alix. Thanks for having me. I think the key thing to think about here is in commodities, we're returning to enduring trends. That's bearish crude oil, bearish copper, and bullish the dollar.
What next? Where do we go from here? There's been this narrative around the dollar that we are going to see dollar weakness. It's never quite materialized. The market's now seeking safety in the dollar. You run basically to the buck when things go bad. what comes next? Because the China story, I'm trying to work out whether or not it is the dominant factor here, Mike, or is it the global slowdown fear driven by Delta?
Guy, I think it's all the above. Let's remember, back about a month ago, China cut their triple R rate. That's never been a good sign for commodities. Beginning of July, U.S. bond yields have been declining. So there's a lot of indications commodities should go lower. And then you look at crude oil. It got to near the highest price it has been near the 2018 peak. I think crude oil, WTI, is going to $50. $50 a barrel really means nothing now that the U.S. average cost of production from shale is $35 on the terminal. So that's very low, and then you just see this elasticity of supply kicking in. So the cure for higher commodity prices is really kicking in. And to me, it's the macro. The stock market has to rise here. Commodities will continue to revert to trend, and that is higher gold prices, lower crude oil, and copper is still around 10,000. It was a bit expensive. It can easily get to 8,000, and it's still above the price it was last year and the year before and the year before that.
All right, Mike, appreciate it. Bloomberg's Mike McGlone, thank you very much. And we'll be talking much more about commodities, taking a deeper dive into that in Commodities Edge today at 1 p.m. New York time, 6 p.m. In London. Guys, sometimes energy aspects saying, hey, maybe OPEC Plus isn't going to release all that oil from the market. That would be definitely a different setup.
It does feel like the perfect day for Commodities Edge. I'm sure you would say every day is the perfect day for Commodities Edge.
For pointy hat people, there is.
Today, definitely, yeah. But I think today for everybody. Not just those that are into the commodity space. I think it is a useful barometer, and the alarm bells are ringing in the commodity space, and you wonder whether other asset classes should be paying a little bit more attention. Mike mentioning what is happening with the dollar spot index rising to the highest level in 9 months on the concerns that we've been talking about. Delta, what's happening with the Fed, all of this in the mix. Let's deal with the details of kind of where the buck is, where it's going, and whether or not this trend continues, because it hurts for emerging markets. It hurts for a lot of people out there. Bloomberg market reporter Kriti Gupta here with the details.
Absolutely, Guy. Well, this is absolutely a cross-asset story. On the one hand, you have that kind of risk-off narrative bid going right into the dollar. You mentioned it. But there are spillover effects as well, because when you have those growth concerns, not only do people pull out of commodities, but they dive into the dollar. And then there is this kind of reverse correlation where, of course, we know commodities are very sensitive to the dollar, just given that those contracts are priced in dollars. And now you're seeing that correlation really increase. I mean, that's really what this chart is showing you. There is an inverse relationship, but that inverse relationship got even stronger just in the last month. So let's get to what's going on today in particular, because I want to talk about that dollar strength, now the highest, not only in 2021, but going all the way back to a year. And you can really see that here. This is, of course, the one-year chart. And you can see in the 2021 timeframe where the recovery trade has really taken precedence, you haven't seen that dollar outperformance until the last month or so when those Delta variant concerns really came to the forefront. But in today's price action, what are the largest contributors? What other currencies aren't doing very well? Which brings me back to the commodity story, because it's that commodities exposure, those commodity currencies that are driving the dollar. The Canadian dollar, you have, of course, the Mexican peso as well, really involved with that commodities picture. Even the Aussie dollar, spot Aussie dollar, down right now, down 0.8%, but it's still contributing to that dollar bid. And then, of course, you have the UK bid as well, really tied here to that recovery trade, to that travel trade. Today, not doing so well on those growth concerns.
All right, Kriti, thanks very much. Really appreciate it. Thanks for that update. Kriti Gupta joining us on FX. All right, coming up, you got stocks, yields, fall. You got the Fed taper concerns, COVID concerns. What do you do? Yana Barton, Eaton Vance Equity Portfolio Manager and Director of Specialty Solutions, will be joining us next. This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Market. So the minutes of the Federal Reserve July 28th meeting indicated FOMC members are getting ready to start tapering bond purchases. The big question is when. Want to bring in Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, the Fed was blamed earlier for the sell-off in Asia, Europe, and earlier in the futures session. What did the Fed actually say?
What the Fed said is dog bites man. There's nothing that I'm going to tell you that the markets didn't know, which is why it seems very unusual that people are blaming the Fed for the market sell-off. This is the key phrase that came out of the minutes yesterday. Most participants noted that provided the economy were to evolve broadly as they anticipated, they judged it could be appropriate to start reducing the pace of asset purchases this year. If the economy evolves as they anticipate, what we'll see is continued drops in the unemployment rate, and we'll see inflation start to roll over. None of that has really happened yet. This is when last year the pandemic began in February, so all this data is what we saw beforehand. And as you can see here, inflation is the only one that is above where it was at the time it began. The unemployment rate is still above where it was, and they want it to be closer to that. And the black unemployment rate, because they're trying to help minorities, still way above where it was. So they're looking for those employment numbers to come down. They do think that they have reached where they want to be in terms of inflation at this point. So the only other question is how and how fast do they taper? And in this case, many of them said taper fast enough to finish before they have to raise rates, because they want the public to distinguish between the two things. Tapering does not mean tightening. Several said if you start sooner, you could taper more slowly, but most of them said also, let's taper proportionately with the mortgages and treasuries going off at the same time. So what do we look for going forward? Well, the question is it going to really change much? Next Friday, a week from tomorrow, we have Jay Powell in Jackson Hole, and he speaks just after we get the PCE inflation numbers, which will matter to the Fed. Then, of course, the August jobs report on September 3rd. And then we have the September 22nd Fed meeting. Is that where they announce tapering? And if they announce it, then do they say when they start? Do they start in November? Do they start in December? Those are questions for the market that may not matter as much now that we already know they're ready to start.
Yep. I guess the first step of a long journey. Mike, thank you very much indeed. Mike McKee on what we've got from the Fed. Looking forward to Jackson Hole next week. The S&P is now positive. The Asian session was horrible. The European session was horrible. Still is. Like the CAC's down by over 2%. But the S&P has just turned positive. 44.01 is where we are now trading. Joining us now to give us a take on the price action is Jana Barton, Eaton Vance, Equity Portfolio Manager and Director of Specialty Solutions. Jana, great to see you. Perfect day to talk to you in so many ways. As I say, look, the price action around the world really negative over the last 24 hours. But today we're starting to see evidence that maybe the US markets, the S&P, is finding a floor. What do you make of the price action?
I think it's reiterating the fact that we're all looking for direction. But bottom line is the investors in the market have been very dismissive of all the known unknowns we've been talking about for weeks, if not months, right? You guys talked about the Delta variant and the implication for normalization of economic activity, geopolitical uncertainty, fluid fiscal policy, and obviously changes in monetary policy. And it really doesn't make sense that the S&P is nearly just down 2% off of its all-time highs. It doesn't make any sense that the valuations on the next 12-month basis, when you look at the PE multiple, is 30% above its 10-year average. I mean, I personally think that we're due for a bit of a breather, and the fact that we've sort of reversed course may be a seasonal or an August phenomenon more than anything else.
So, Jana, it's such a good point, because on the fundamental basis, I mean, when you take into account the Delta variant, Goldman also cut its U.S. growth forecast overnight. I just want to read to you what they said. They said the impact of the Delta variant on growth and inflation is proving to be somewhat larger than we expected. The Delta variant and other disruptions are also likely to further raise prices of supply-constrained durable goods through year end. And you heard the Fed saying that the inflation risks were to the upside while the growth risks were to the downside. Why do you buy the dip? And if you have to buy the dip, where do you do that?
I think you go with the laggards. You go with the areas of the market that have already witnessed both the valuation, the price reset, and fortunately for investors, particularly those focused on the long term, you actually have plenty of opportunities. You look at the worst performing sector like consumer discretionary that I believe is poised to reverse the trend. And we're not just talking about retailers, we're talking about secular growth opportunities within the auto components as well as the internet retailers that have been down year to date. You look at healthcare that until the last couple of days, it has been an underperformer with free cash flow yield that approaches 5 percentage points and valuation at a huge discount to the market. And lastly, I think you look at tech. If you're looking for cyclical and secular exposure, I don't think you need to look any further than technology space.
Okay. how do I factor inflation into all of that, though, Jana? Alex and I talk to CEOs every day, and what they tell us is that they are certainly facing cost pressure when it comes to labor and input costs, commodities, etc., going into their businesses. We're also seeing, obviously, what is happening with the dollar. We're seeing what's happening with China. They're shutting down ports. That's going to make this all a lot worse. Do I need to put a bigger discount into the equity market? Do I need to change the way I look at PEs to factor in that inflation? And do you think the market has done that already?
The short answer is yes. And the second part of your question, it's no. As I mentioned, the PE on the next 12-month basis on the S&P is nearly 21 times relative to historic average in mid-teens. But I think the question that you're asking is a really important one, which is the cost of doing business is heading higher, whether it's inflationary pressures, whether it's wage pressures, whether it's input costs, whether it's supply chain issues. All of the things you guys have talked about is spot on. And the fact that the cost of doing business is going higher, you need to have pricing power. That's the key word. Innovation is the ultimate solution, but ultimately you need to have the agility in your revenue model and your cost model to pass that through so it doesn't impact your margin profile. Again, I go back to the sectors that I mentioned to you. There is that elasticity and there is that flexibility in the model to do so because you're starting at such a high spread relative to the market, particularly within the information technology space.
So, Jana, to that point, what are multiples like in that area since they've sold off recently? And I take a look at Amazon, which is below its 200-day moving average, finding some footing today. But have there been some opportunities that have opened up in the last couple weeks for those kind of names? If so, where?
Absolutely. I mean, Amazon, to your point, has actually seen its multiple correct nearly 30 percentage points year to date. And again, I would just highlight this is a company that's growing its top line nearly 40 percentage points. So while the multiple on an absolute basis still is expensive, you can certainly say that I think relative to its growth rate, there are multiple ways to make the numbers work because of the multiple sort of conglomerate businesses this company is in. Within the information technology space, I think hardware equipment, Apple in particular, because it's such a disproportionate weight of the index and industry, has also seen its valuation retreat, and it has been a laggard. And I think one of the biggest sort of anchoring to the overall market. If you believe in all the secular trends of 5G and all the things that we've talked about, sort of the enablement of digital economy, they're in it. So that's another area. Hardware, equipment, software, semi space has also lagged. We talk about shortages and necessity of semis in our everyday life, and yet that area of the market is an underperformer year to date. And by the way, is trading at a discount to the market. So if you look hard enough, I think there are plenty of opportunities, whether you define yourself as value or growth investor.
Yeah, no, great stuff. Really appreciate it, Anna Barton of Eaton Vance. Thank you very much. Coming up, Robinhood dropping like a stone. That's a big gap down after warning on a slowdown, overshadowing a boom in crypto trading. More on that coming up next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Laura Wright. Macy's is out with a sales forecast for the fiscal year that beats estimates. The department store chain also reinstated its quarterly dividend and authorized a $500 million stock buyback. Macy's same-store sales soared 61% in the most recent quarter, well above expectations. Amazon reportedly will expand into an area where it has been a disruptor traditionally, bricks and mortar retail. According to Dow Jones, Amazon plans to open several large physical retail stores in the US. They're designed to extend the company's reach in clothing, household items, electronics, and other products. Shares of DoorDash are lower. SoftBank has offered a block of the restaurant food delivery service worth about $2.2 billion. DoorDash stock has climbed about 4% in the last month. That's the Bloomberg Business Flash. Alex, I've heard Guy is a big fan of takeaways.
Is he? Are you, Guy?
It couldn't be further from the truth.
Okay.
But Laura's having a little fun with me.
I wouldn't think so, because you live in the middle of nowhere, right?
There is that.
There's also
Though
that.
Deliveroo apparently is coming to the little area that I live in. So you never know.
You never know. You never know. Okay, thanks, Laura. Appreciate that. Okay, Robinhood's first earnings report as a public company came complete with a warning that the trading in its key product may actually be on the way down. You can see the gap down in the stock. Bloomberg Dave Wilson looking into the details. Hey, Dave.
Hey, Alex. Yeah, I mean, you're talking about a company whose revenue more than doubled in the second quarter from a year ago. Now, they had a bigger loss than analysts expected. That was largely the result of changes in the value of convertible debt and warrants in response to Robinhood's debut as a public company. Now, what's interesting, though, is if you dig into the results, you see that transactions accounted for about 80% of Robinhood's revenue in the quarter. And then from there, well, I mean, we tend to associate Robinhood with trading in meme stocks. Well, stocks are actually the smallest piece of its revenue. It's much more involved with options. And in the last quarter, what changed is that they got more than half of their transaction revenue from cryptocurrencies. In fact, CEO Vlad Tenev said on a conference call yesterday that they had a larger share of first trades by new customers in crypto as opposed to shares, and that hadn't happened before. So, clearly things are swinging, and as a result, Robinhood, more susceptible to what's happening in the cryptocurrency markets. In terms of accounts, though, more than doubled from a year ago. Here's the thing, though. They're talking about considerably fewer funded accounts in terms of growth this quarter and a potential drop in revenue. And they're citing, at least what they said in the press release, seasonal headwinds and lower trading activity across the industry.
Dave, a few months ago, the risks we were focusing on when it comes to this business were payment for order flow and regulatory risk around that. And those kinds of issues were where investors were. As you say, the pendulum's completely swung away from equities. So where do the risks lie now? And is that risk, the payment for order flow risk, now kind of fading into the background?
Well, I mean, the risks are just what happens to the crypto markets from here. We've seen trading slow down. It peaked in May. And bear in mind, in the latest quarter, 62% of Robinhood's crypto revenue came from that joke currency Dogecoin. So if people decide they're not in on the joke anymore, I mean, that becomes a concern for the business down the line as well.
Mr. Dave Wilson, always a pleasure. Great to see you. Thank you very much indeed. Dave Wilson on Robinhood. Up next, we're going to get to what is happening with the retail story. Pretty strong seems to be the narrative at the moment. It's interesting what is happening with clothing, different picture for groceries. We're going to get the latest in a moment. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. This is Bloomberg Markets. Alex, let's talk about what is happening in the retail space. I know commodities are your kind of favorite area.
I shop.
But
I'm a shopper.
But I do feel that retail comes a very close second in kind of your loyalties and where they lie. Abigail Doolittle is here to kind of tell us what's going on. I've been listening to some of the comments, Abigail, and they're incredibly strong. The CEOs are talking about a really buoyant environment. The equity market, not so much.
Well, the equity market overall, maybe not so much, but Macy's, take a look at this guy, up 14%. Its best day since November of last year. So investors responding very well to a strong quarter out of Macy's. They beat adjusted earnings estimates by 559%, putting up $1.29. They also beat sales estimates by about 12%. That was more than $5 billion. So super strong. Jeff Gannett's turnaround plan clearly taking hold. Estee Lauder also beat, but that gain pales in comparison. If we break it down for Macy's a little bit more, if they beat adjusted earnings so much, you won't be surprised to see that comp sales absolutely soaring for a second quarter in a row, up 61%. That is just extraordinary. That's the reopening trade right there after the pandemic. Same-store sales down for a few quarters. Again, huge 2 quarters in a row. Now, if we break down the earnings just a little bit more, it wasn't just about the results. They also reinstated their quarterly dividend of 15 cents per share. So on top of comps rise, same-store sales rising 61%, on top of saying that sales could be $24 billion this year, dividend back in place, The question, though, is how will the company deal with Delta? But if we take a look at Macy's on the year, not only is it the best day of the year, it is the best year right now ever, going back to 1993. Macy's up about 85% on the year, beating a retail index, also beating Estee Lauder. So Macy's, Alex, clearly firing on all cylinders. Stellar performance. But again, will Delta crimp that? Yeah,
Literally a sentence I never thought that we'd hear someone say about Macy's. Abigail, thank you so much. I appreciate it. Bloomberg's Abigail Doolittle. Let's break it down more with Paula Rosenblum, RSR Research Managing Partner. Hey, Paula, is this as good as it gets when it comes to the retail guys that have really been operating on all cylinders with the reopening here?
This is as good as it gets for now, for sure. I think Delta has created problems that none of us ever expected. There's all kinds of memes going around about my plans for the fall, and then along came Delta and they changed. But Macy's results are nothing short of stunning, and I think it bodes well. Now, I don't know if it's a rebound romance due to pent-up demand or if, in fact, it's going to stick. But certainly for now, shoppers are really eager to get out back in the streets.
It kind of feels like people are shopping for fun, but I can understand that, I guess, to a little bit. I think it feels like, it genuinely feels like this is a kind of leisure activity at the moment. It's not the ultimate end game is to buy something, but going shopping feels like a complete relief after we've been all stuck in for so long. Paul, I was really curious earlier on in the week. The CEOs were coming out, call after call after call, sounding super positive, and yet we got quite negative market reactions.
Yes.
I'm a bit perplexed.
Me too. Quite honestly, it doesn't make a lot of sense. I know there's fear about Delta. I know there's fear about sustainability, not sustainability in the sense of product sustainability, but I know there's fear about the ability to sustain those sales. And there's definitely a sense that Delta is going to drive everyone back, has driven everyone back into their homes. But I'm perplexed, and I don't think it's right, quite frankly, because it tells us that the basics are there, particularly in the companies that did really, really well. If I take Macy's out of the picture, if I look at Target, they only have upside to go. Walmart continues to have upside to go. Lowe's has made some strategic shifts that really are helping it, and Home Depot is doing well. And TJX is doing better in its home goods area than it is in its apparel area, but that will rise as well.
First of all, Guy, retail shopping is leisure. That's a thing. It's always been a thing. That's never a thing.
Okay. It strikes me as a bit peculiar, but after being stuck in for so long, even I occasionally now visit the shops.
Yeah, Paula, he bought
it seems like quite fun.
Okay, so Paula, three pairs of jeans. Okay, Paula, so a couple main events that happens for retail: back to school and the holiday shopping season. What's your expectation for back to school plus Delta, and what about the more port closures over in China in terms of inventory and the availability of supply for Christmas?
I've been really obsessing and worrying about the long supply chain for a very long time. And I don't necessarily blame it on what's going on in China. The carriers don't strike me as not having the kind of sense of urgency they need to have to get product unloaded quickly and to get containers of product from the US back out to China. So there are some issues there for sure. Overall, I think the holiday should be good. I mean, unless Delta just keeps getting worse and worse and worse. The booster shots are going to, no pun intended, give everyone a boost and make them feel safer. And I expect there to be a good holiday season. I can't say I'm as bullish as I was a month and a half ago, but I remain pretty bullish and baffled by the market, quite honest.
Okay. I often am baffled as well. Today seems like an interesting kind of point in time to maybe judge all of that. Paula, one of the stories that we've been talking about actually that has, I think, confounded a lot of people as well has been Amazon's share price performance. It's gone nowhere for a very long time. I appreciate that we're all going out and shopping in physical retail stores now and potentially enjoying the experience. Amazon wants a piece of that. It wants to get into physical bricks and mortar. If it does open department stores focused on its own stuff, who's going to suffer? Who does that take business away from?
Well, it depends what they put in them, because they're actually not going to be full-size department stores. I mean, theoretically, you would say they would take away from everyone. But if it's all apparel, they're going to have one set of, they're going to have one set of competitors. If they try and be like the next Sears, which frankly I always thought they should do, was buy Sears at a discount so that they would have ready-built locations. It also gives them the option to not ship everything by air, because they can take a piece of that store and they can use it to get product to customers for less money.
Paula,
yes.
sorry, no, keep going. I didn't mean to cut you off.
No, it's important to understand that most online pure play retailers don't make a lot of profits. We always underestimate shipping costs. And just because you have your own plane doesn't mean that it's going to save you any money over the long or short term. You still are shipping, you're still paying gas, you're still dealing with pilots, you're still dealing with all the expense that there's an entire industry built around. And there's an old joke about somebody needing a tank of gas in his Volkswagen, so he went out and he bought an oil well. I kind of feel that way about Amazon cargo planes. Somehow Walmart has managed to do fine without its own fleet of planes. So I think their goal is to get a bit closer to the customer, so they're only dealing with the last mile, and then they can deal with the other miles in bulk, if you will.
Such a good point, Paula. One more before I let you go. Luxury retail getting really slammed over in Europe. The exposure to the Chinese consumer, which could come under pressure as the Chinese government really cracks down on billionaires, reigning true there. What's the effect? What's your call on it?
Well, I thought luxury was going to have issues anyway, because I don't think millennials have the same feeling about luxury products as Gen X and boomers. And Gen X and boomers are starting to age out of that mix. So I always expected that luxury was going to run into headwinds. And in some ways, ironically, part of what will save it is the secondhand or consignment market. So I think there's going to be some trouble ahead. I know that fashion in particular, and Stella McCartney is leading this charge, is really starting to focus on sustainability so that it doesn't feel completely like conspicuous consumption. I mean, the data around the amount of cotton that gets wasted as part of the production process is huge. And so she in particular is working very hard to find a way to reuse that cotton in interesting ways. And that may help the luxury market, assuming that China comes back to what it was.
Paula, always a pleasure. That was fun. Great to see you. Come back again soon. Paula Rosenblum, RSR Research Managing Partner. I'm sure retail is fun. I'm sure shopping is fun. I want to take you to the Pentagon. We are getting our daily briefing, an update on what is happening in Kabul. Army Major General Hank Taylor alongside John Kirby briefing from the Pentagon right now. Let me just give you some of the stats and some of the numbers we're getting out of that. The U.S. now has more than 5,200 troops in Kabul. It's evacuated more than 2,000 people over the last day. More than 7,000 people have been evacuated since August the 14th. We will continue to monitor this briefing and bring you details from it as it progresses. What do we got coming up for you? The global chip shortage forcing Toyota to slash production in September. Robert Charter, Toyota Motors North American Executive Vice President of Sales. He's going to be joining us next. This is Bloomberg.
This is Bloomberg Markets. I'm Laura Wright. You're looking at a live shot of the principal room. Coming up, Debbie Dingle of Michigan. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
What we saw recently is light of hopes. I will not say 100%, but light of hopes of improvement. But unfortunately, the Southeast Asia pandemic surged, and we are seeing impact on the global industry again.
So that was the Nissan COO talking to Bloomberg yesterday. The news overnight out of the auto sector is that Toyota has seen its shares fall really quite significantly. This after the company cut its September outputs due to chip shortages. It is projecting a reduction of approximately 60,000 to 90,000 vehicles in August in North American plants. Joining us now is Bloomberg's Craig Trudell. Craig, my understanding was that Toyota was managing this chip crisis really well. In fact, it was outpacing its rivals. Is there a connection between, we just heard from Nissan, now we're talking about Toyota. Is this a problem that we're seeing between these two companies? And is there a kind of connection between what they're saying?
There absolutely is. And it was incredible, the news out of Nissan just earlier this week that they would have some downtime at their plant in Tennessee related to issues in Malaysia. So, this is, I think, a perfect example of just how far the supply chain reaches for the car industry. So there's a COVID outbreak in Malaysia, and you feel ripple effects in Tennessee. With Toyota, you're hearing a similar message where they're talking about the idea that Southeast Asia is a real pinch point for them at the moment. Earlier in the year, we experienced a real shock to the industry with a chip supplier in Japan having a fire, and the industry really having a serious impact from that. Because this was such a big supplier. Toyota really sort of learned from the experience of the 2011 earthquake and tsunami that did such a number on its production back in 2011, and put in place, efforts to really try to make sure that level of disruption didn't happen again. The company really had a heck of a time with managing to limit the damage early this year from the chip shortage, but we're starting to see that combined with just the effects of lockdowns in Southeast Asia really starting to hit their operations this month and in September.
Hey, Craig, quick follow on that. Most car companies are getting hit with the chip shortage. So why did this catch the market so by surprise?
I think the combination of the extent to which Toyota was able to manage through this up to this point, and I think the market was kind of anticipating actually Toyota to increase their forecasts recently. I think there was maybe a little bit of a shock of, oh my gosh, 40% is quite a significant drop for September. I think it's also a matter of beyond September, Toyota sort of warning that there may be sort of continuing pressure. I think we're getting to a point where the industry is really depleted on inventory. Even companies that have managed to keep production going, like Toyota, are really, really low on supply, particularly in the U.S., down to just a couple weeks across their dealerships.
Wow. Craig, thanks a lot. Really good setup for us. Thank you, Bloomberg's Craig Trudell, joining us there. Well, joining us for more is Robert Carter, Toyota North America Executive Vice President of Sales. Robert, thank you for joining us. We learned today that we're going to see a production shutdown in some plants here in the U.S. because of the chip shortage. What's going to fix this? When can these plants get up and running?
Well, good morning, and thank you for having me on this morning. But as Craig just appropriately outlined, his statements were accurate. We're very proud that we've been managing this supply chain disruption very well over the last 4 to 6 months. But quite frankly, due to the disruptions we're seeing in Southeast Asia as well as in Europe, we had to announce overnight that we're going to be reducing production in the month of August between that 60 to 90,000 units. And again, we're evaluating the impact on September, but it appears to be 70 to 90,000. I will say, Anna, that this is far beyond just microchips, although microchips are the center of most of this activity. But we're seeing a wide range of supplier disruptions due largely to continued outbreak of COVID.
Robert, you've done a really good job managing your dealership network. You've been really flexible, really kind of coordinated. You've actually had a really good communication strategy with dealing with them, and this has been reported pretty widely. This isn't just me saying this. What are the dealers saying right now? How kind of under strain is the inventory program? How flexible is it in terms of being able to get vehicles from one place to another where potentially they could be sold, to manage that kind of inventory that you do have as nimbly as you can?
Well, thank you for that. We communicate extremely well with our dealer and retail partners. What's a little bit of frustration is that natural demand for the industry remains to be very high. If we're projecting demand without supply chain disruption is in excess of 17 million units on an annualized basis. But as we've been seeing over the last largely 60 days, the industry sales are coming down to around a 14.5 market as inventories are just purely depleted. So I'll give you a good example of that. Last month, we started the month with about 40,000 units in inventory, but yet we're able to sell 225,000 units. And that's because of our 15 plants here in North America, we're continuing to produce. And our dealers do an excellent job with serving the customer for throughput. But now with, as we just previously said, the supply chains in Southeast Asia and in Europe are so critical that we're just not able to continue that level of production for the months of August, and it will go into September.
So, Robert, I wonder what the long-term fix is. Obviously, we can make chips at home in the U.S. Okay, that makes sense. But we're also having sort of partial closures from ports in China, for example. It feels like herd immunity for COVID's getting pushed out and pushed out. It may not be there at all. So this may become a full reality of life. How do you fix it to still run your business?
Well, that's a complex question right now. What we really need to do as an industry is we need to solve this pandemic and bring a safe work environment to our team members. I'm really proud of our 15 plants here in North America. We are up and producing. We're social distancing. We've returned to 100% mask wearing. We do have a very solid plan in North America, but yet we are dependent upon second and third tier suppliers that are coming out of Asia and Europe. And that is really the issue of this problem. So many moving parts, many challenges to solve, but as was pointed out a little earlier, I'm confident that we can get through this period of time, but it's going to be a situation where consumer demand is going to far exceed supply for the auto industry over the next 60, perhaps 90 days.
What does this mean for used vehicles and the residual values that they carry? How much longer do you think we're going to see these incredibly elevated prices? We're starting to see some evidence that used prices are coming down. Do you think, what is your expectation for kind of how steep that curve is? If at all, are we going to see kind of reduced prices going forward?
Well, it's simple supply and demand. As new cars are not able to meet the current supply level of the demand that's in the market, used cars, particularly 1 to 3 year used cars, have accelerated in price. Over the past week, maybe 10 days, we've seen a little bit of softening of used cars pricing, but I think that that's normal because as we move into late summer and into fall, natural demand tends to subside. So I do expect used car prices to remain elevated until we see some normalization of new car inventories.
Before we let you go, Robert, I'd like to just get your take on the new EV mandate from the Biden administration, pushing for 40% of car sales to be EVs by 2030. Can you meet that? I mean, you're looking at about 20% of your sales coming from battery EVs and fuel cells in 2030. What do you think of that 40%?
Well, we're all in. And when I will remind your listeners that globally, Toyota has sold more electrified vehicles than all other manufacturers combined. When you take a look at our hybrids, our plug-in hybrids, our fuel cells, and our battery electric vehicles. Hybrid is up to about 26% of our business, and we look to grow our electrified business up to nearly 70% at the end of this decade. But we are returning to the full BEV market, and we'll have 2 of those in the market.
Robert, great to speak with you today. Thank you very much indeed. Really appreciate your time. Robert Carter of Toyota Motors North America. This is Bloomberg. Asian, European stocks getting hit hard overnight. Europe is still down. But American markets, American equity markets, they're flat. The dollar taking a leg higher. What does this mean from a technical point of view? We're going to answer that question next. David Snedden, Credit Suisse's head of technical analysis, joining us in the next hour. This is Bloomberg.